Investing in a time of change can be a tough business. So what are the fund managers at the top end of town recommending to their clients right now? Time to ask one of the country's best and most outspoken fundies. Welcome to Anton Tagliaferro, mate. Thanks for joining us on Switzer.
Good, thanks, Pete.
Anton, you know, it must have been just before Christmas, maybe a little bit after you contacted me. You said, I got a feeling we're getting to the end of this bear market, and it was a little bit before that turned up. But I guess if I'd followed your advice and bought some shares at fantastic prices, I'd be laughing right now because the rally's come through. How have you done, since that time?
Oh, not too bad. I mean, I think the rally's been a lot of it's been in some of the riskier stocks, which got really belted down in the downturn. So look, we've recovered. Our unit price for the year is down about 10%, which isn't too bad. The market's down about 20%.
That's a good result, really, isn't it?
Well, it's not great, but it's all right.
It's better than the benchmark. I noticed you mentioned in dispatches when it comes to the better performing funds. Have you ever lived through a tougher time on the stock market? No,
I have to be honest. It's been extraordinary. I think the last 12, 18 months have been... I don't think many of us, even those of us who've been around for a while, have ever seen anything quite like what's happened in the last 12, 18 months. In terms of the complete chaos, confusion, panic, and to some extent, we still have a bit of confusion, to be honest. I don't think anybody's got a really clear view of where the world's going. But I think the worst of the panic is over. Now I think it's going to be a tough grind, to recover.
We've heard lots of people talk about the pullback. Do you think a pullback is going to be on to bring that rally, which started around March 6? Do you see it coming back maybe 10 or 15% before it turns around and resumes again? Or is that just too much like guesswork?
Look, we've had a reasonable pullback anyway in the last few weeks. It might drop a little bit more, but I think we're going to go into a sideways trading market now. The economy is slow. Australia's obviously doing better than overseas, although I think we've got to see what what happens once all this government stimulus is out of the system. So I think the recovery will be pretty patchy, which means again corporate profits won't take off in a hurry, which means it's going to be a very selective sort of market.
I guess when you think about it, the market fell about 50% at its worst. So to get back to where we were, we really have to retrace about 100%, don't we, to get back?
Yeah, but again, having said that, you'd have to say that a lot of stocks that were in the market was at its high. We'll never see them again. Those sort of levels. A lot of the very highly geared LPTs, etc., listed property trusts, whatever. It's going to take a very, very long time. So, look, I don't think you should just say, well, it's fallen 50%, so it'll recover, whatever. But I think the good news about what happened since March, I think, is the market rally, pardon me, has allowed a lot of companies to raise capital. And I think that's a real positive, because I think I was, pretty fearful in January and February, the way the market was falling, and there were so many companies that had a lot of debt they had to sort out. And, we've seen BlueScope, OneSteel, Mirvac, GPT, you've seen dozens of companies raise a lot of money thanks to that sort of spurt of confidence. And in many ways, that'll soften how bad it could have been, because a lot of those companies, had the market continued to fall, and had they not been able to access the share market, would probably be in a bit of trouble today.
Yeah, and in a sense, when investors find the money for these companies, it's one of the best examples of confidence coming back to the market, isn't it?
It is, Pete, and look, that's one of the reasons the stock market is there, is to help, and this is why I've been so anti-short selling. The share market is there to help money go from investors into real companies to help, hopefully, either pay down their debt or expand. So that's very good to see, I think, in the last 3 months. So I think that's a real plus, because if you think about, as I said, a lot of those companies I talked about, even GPT, all these companies, had they not been able to raise the money they have, they'd be they'd be looking pretty shocking at the moment.
Clearly, you invest primarily in Australian stocks. Right? So the link from Wall Street has been certainly proved in this particular cycle. Do you research heavily of what's going to happen on Wall Street to work out the implications for local stocks?
No, but I think you've got to look at the US economy, and the US economy has some serious issues, and it's going to take them a fair while to get out of them. I mean, they have a housing market which is still in a shocking state. I mean, it's not falling as fast as it was last year, but it's certainly not picking up.
No.
The banking system has still got some issues, although again they've raised money. The government, I mean, that's another good thing, you know, all around the world, is governments have basically stepped in now and guaranteed banks, you know. So that panic we had after the Lehman Brothers in September, which, you know, everyone was looking around thinking which bank's going to go broke. Well, that seems to be over now, because every bank in the world, every government in the world is basically standing behind their banks. So that's another positive, actually, I think.
So therefore you're a bit sceptical about the green shoots, or you just think that they're just poking out and they haven't grown much in the last month or two?
Well, you can get, you know, green shoots can be weeds as well, I guess, but, you know,
You're a hard man,
it doesn't... Well, look, in terms of green shoots, sure, things were, the whole economy, everything, house prices in the US were falling so fast, they couldn't continue at that rate. No. They're not falling as fast.
No, consumer confidence improved and manufacturing
in terms of, is it going to come roaring back in a hurry? I don't think so, you know, I don't think that's right. So in terms of what does that mean for the stock market, it means things aren't going to fall apart, which is good, but it also means don't expect it to sort of tear away in the short term either.
The AFR had a survey on the weekend, I don't know if you saw it, the equity analysts, the consensus was the market would get to 4,800 by the end of the next financial year. What's your view on?
Well, I hope so.
But what do you think?
Look, again, it's hard to put an index number. I mean, I guess by this time next year, the market will be looking out another year, you know, and you know, hopefully by then we'll see a bit more of a recovery coming through. I think it's going to be a much slower. I mean, I remember in the early 90s, you know, if you look at the 92 and 94, you know, they were very slow sort of years. 94, 95, 96, they were sort of 10%, 5 to 10% years in the stock market, which is not bad, you know. 5 or 10% plus a bit of yield is reasonable. So I don't think one can expect too much in the short term until, you know, the recovery takes hold. And I mean, I think there's still so much leverage, you know, in the system. It's going to take a while to sort out.
But for you at Investors Mutual, you have to produce results quarterly and annually. Yeah. So it's a lot tougher than a long-term investor. If you're advising a long-term investor who doesn't really give a damn over the next 1 or 2 years, is this a buying opportunity, do you think?
The question is, will you get the chance to buy things cheaper in the next month or two? No one knows, right? And will we get shocks along the way? We might get a few little ones, not as big as the ones we had last year, you know. But I think, look, as I said, I think where the opportunities will come is where some of these companies, even some of the LPTs, which we've been very cautious on, the Mirvacs, the ING Office Trust, you know, which have now recapitalised, they fixed their balance sheet. And I think those sort of companies, if you believe, you know, their yields look pretty sustainable now at 6, 7, 8%. So I think those sort of companies, if you're prepared to wait, they should do reasonably well in 3 to 5 years.
And the beaten up companies are often the ones that eventually do roar back after having a bad time.
Well, they do, as long as I said, the problem with this downturn was a lot of those companies did have serious balance sheet problems. And the good news is, as I said, that since March, a lot of these companies have raised a lot of money, and to a certain extent, they've fixed up that big financial risk. So, so the financial risk is gone. Now, hopefully, you know, something like Mirvac, it's a matter of when will housing, when will residential do better for the stock price to perform. But a lot of the big financial risks from these stocks has now been eliminated.
Okay, we're nearly out of time, mate. Are we in a bear market or a bull market?
No, it's a bear market. I mean, you know, look, bear, bull, whatever. As I said, I think we're going to go sideways for a while. We'll have rallies, we'll have things, and yeah, I can't see stocks roaring away because I can't see earnings growth, you know, coming back in a hurry. And unless there is strong earnings growth, you know, your P's are not going to expand. So, and you know, I don't think we'll see that for a little while.
Mate, thanks for joining us on Switzer.
Always a pleasure.